All right, let's get right into it. Welcome to the Strategic Explainer, where we are totally cutting through the noise to look at the absolute best data available for the Philippine stock market for the week of June 15, 2026. Look, if you're a young retail investor trying to build real, sustainable wealth, it is incredibly easy to get caught up in the daily hype of whatever is trending on social media. But today we are putting on our analyst hats. We're doing a complete market vibe check and building a strategy playbook that focuses specifically on those big, blue-chip conglomerates. We're going to dive into the data, spot the actual discounts, and separate the real solid buys from the stocks you just need to patiently watch. Let's go.
So I have to ask you a serious question right up front. Are you missing the biggest blue-chip discount of the decade? Right now, in June 2026, the market is super volatile, it's searching for a catalyst, and is trading in the lower half of its 52-week range. And honestly, a lot of young investors are falling hard for FOMO, that fear of missing out, and they're chasing stocks that have already peaked. Meanwhile, there is massive, undeniable value hiding in plain sight in the PSEi. If you just know where to look, there are premium companies literally sitting right in the bargain bin.
Okay, 20%. I want you to keep that magic number in your head because the broad market is historically cheap right now. The PSEi price-to-earnings, or PE ratio, is currently sitting at 15.52. That is a full 20% below its 10-year median of 19.35. So what does this all mean in simple terms? The market as a whole is on sale. When the index trades this far below its historical average, it is a massive, flashing neon indicator for value investors to start looking very, very closely at fundamentally strong companies.
Now, the absolute clearest value play in the entire index right now is BDO Unibank. It is the PSEi's largest bank by assets, yet it is trading at a rock-bottom PE ratio of just 7.03. I mean, compare that to the current market average of 15.52 and the historical median of over 19. BDO is quite literally one of the cheapest large-cap banks in all of Southeast Asia at this moment. 12 out of 12 analysts rated it a strong buy, with an average price target of over 165 pesos. That gives it a massive 42.5% upside potential. And here is the real kicker for us young wealth builders. When you buy fundamentally strong companies at a super low entry price, your effective dividend yield shoots right up.
But to really understand why these stocks are going to move, we have to zoom out and look at the bigger picture. Here is your macro vibe check. The Bangko Sentral in Pilipinas, the BSP, is currently in an easing cycle. They actually just made their 6th consecutive cut, bringing the policy rate down to 4.25%. This is a total game changer. As interest rates fall, those high yields you might be getting from standard bank deposits or digital banks, those start to dry up. Suddenly, the dividend income potential from these undervalued blue-chip stocks looks incredibly attractive compared to just parking your cash in a savings account. Add in a really healthy 2026 GDP growth forecast of around 6.2%, which is being driven by consumption, and it's super easy to see why the analyst consensus for the PSEi year-end target is 7,100. That implies roughly a 20% upside from where we are right now.
Section 1. The Bag Alert, the Buy Now Zone.
All right, grab your notes because here is your cheat sheet for limit orders, so you aren't just guessing out there. For BDO, we are actively hunting for entries between 110 and 120 pesos. SM Investments is hovering around 610, but your absolute prime strike zone is down around 587 to 625. And Ayala Corporation? It presents a massive margin of safety if you can catch it between 520 and 555 pesos. Setting your entry prices squarely in these zones ensures you are actually securing a real discount. Understanding the difference between buying true value and just chasing hype is absolutely crucial for your portfolio. Take SM Investments, for example. It's trading near its 52-week low of 587 pesos, having lost 22% over the past year. But wait, look under the hood at the underlying business. They actually posted a positive 7% profit growth in Q1 of 2026. Now, compare that narrative to ICTSI. Now, don't get me wrong, it's a phenomenal business. It's the world's largest independent port operator, but the stock just hit an all-time high of 892 pesos. It is up more than 100% from its low. As a young investor, you absolutely do not want to be the one buying at the absolute peak. You want to be looking at the fundamentally solid company that the market has just temporarily mispriced.
And that brings us perfectly to the massive potential of SM Investments. Because it's sitting near that 52-week low, despite positive profit growth driven by its retail segment, it is trading at roughly a 30% discount to analyst consensus fair value. Now yes, management has guided for slightly slower growth in the near term, but historically speaking, this kind of setup has been a phenomenal contrarian entry signal. With its super diversified model across BDO Banking, SM Prime Malls, and SM Markets, analysts are projecting a 50 to 65% upside potential. That, my friends, is exactly how you buy the discount.
Now let's talk about our third high-conviction buy, Ayala Corporation. Just this week, the Japan credit rating agency reaffirmed Ayala Corp's A issuer rating. That is a huge vote of confidence in their financial strength. Plus, they are making massive moves into ESG, environmental, social, and governance investing. Their energy arm, PSEi, literally just injected 1.15 billion pesos into a Zambales solar project. Ayala gives you extreme stability with its diversification across banking with BPI, telecom with Globe, property with ALI, and renewables. And right now, it's trading an incredible 33% below consensus fair value. You just can't ignore that.
Section 2. The patience plays. The watch and wait list.
Okay, so here's where you literally need to sit on your hands and just monitor these specific watch zones. JG's Summit needs a pullback to the 22 to 24 peso range. For Abati's Equity Ventures, we're going to wait for the 26 to 27.50 zone. ICTSI, as we just discussed, is flying way too high. We need to see a meaningful 15 to 20% haircut down to the 700 to 750 range before even touching it. And if Ayala Land dips into the 22 to 24 peso territory, well, that is your attractive long-term entry.
So why exactly are we waiting on AEV, for example? Because of this number right here, 25.76. That is Aboitiz Equity Ventures' current PE ratio. Remember how incredibly cheap BDO was at 7? Well, AEV sitting at nearly 26 makes it the priciest conglomerate on a valuation basis right now compared to its peers. They definitely have great strategic assets, like their Visayas energy grid exposure for sure, but at this price you are simply overpaying. We really need to wait for what analysts call PE compression. Basically, either their stock price needs to drop to match their real value, or their actual earnings need to catch up to all this hype before we jump in.
And here is exactly what is keeping the other stocks firmly on the waiting list. For JG Summit, they've already bounced super hard from their lows and are trading right near their 52-week high. There is minimal upside left to the analyst target, and honestly, we really need to see Cebu Pacific earnings recover first before making a move. For Ayala Land, analysts just cut their fair value estimate down to 27.42. That's due to softer revenue assumptions and higher real estate bank loan exposure. The whole property sector still faces some pretty stiff headwinds right now. And ICTSI, again, they just completed a massive acquisition and the stock is hitting all-time highs. It's an excellent company, absolutely, but it is simply not a value buy at current levels. We wait.
Section 3. The reality check. Risks and your portfolio checklist.
All right, let's be real for a second. We can't ignore the potholes. These are the macro-level risks that could totally stall the market's momentum. First off, any escalation in the Middle East conflict directly threatens remittances from overseas Filipino workers, and it drives up global oil prices, which basically imports inflation right to us. In fact, the BSP has already raised their 2026 inflation risk to 5.1% because of this very thing. Second, the BIR is preparing to roll out the global minimum tax, known as Pillar 2, which could definitely raise effective tax rates and squeeze conglomerate earnings. Third, we are coming off a pretty weak Q4 2025 GDP print of 3.0%, so consumer spending really needs to prove it can recover. Fourth, if inflation rebounds, the BSP might pause their rate cuts, which removes a massive tailwind for the market. And finally, ongoing geopolitical tensions in the South China Sea between China and the Philippines can always spark sudden, unexpected market volatility. Keep your eyes on all of these.
Taking all of that into account, here is your ultimate young analyst playbook to run through before you make a move. Step 1. Always verify your stock's entry price against the target buy zones we just discussed. Do not pay a premium. Step 2. Compare the stock's PE ratio to the 10-year industry median to ensure you are actually getting a real discount. Step 3. Keep a super close eye on inflation data and BSP policy rate updates because they will dictate the market's direction. And Step 4. Exercise extreme patience. Seriously, wait for pullbacks on those overhyped stocks and do not let FOMO dictate your wealth-building journey.
So, I'm going to leave you with this final crucial thought to review your own portfolio right now. Are you actually buying the discount, or are you just chasing the hype? The data clearly shows us there is incredible value sitting in the PSEi today. If you just stick to the strategy, ignore the daily noise, and wait for the perfect pitch. Thanks so much for joining me on this explainer. Stay focused out there, and happy analyzing.